fixed assets like debt mutual funds are also subject to market risk, interest rate, and FDs, etc. are going down. So what should be the best fixed assets?
So let me just put it in, I know, sir, there have been a lot of issues about certain funds and certain AMCs on certain defaults which have taken place. Let me just put it in very simple terms. Let's imagine you have to lend 100 rupees and there are 3 friends who give you a call. Okay. One friend works in a very good company, very good person, very good profile. He says, Amit, I require 100 rupees. Can you lend it to me? I'll give you 7% return. Second friend calls you up. He says, I require that 100 rupees. He works in a moderate company, a decent payment record. Okay. But he says, I'll give you 9% return. And there's a third person who's lost his job, but generally he's a little casual with money. He says, can you give me 100 rupees, but I'll give you 12%. Where will you lend your money? I'm not saying person A is good or B is good or C is good. All 3 are good because A is giving you, has very least amount of risk, but it's giving you 7%. B has got slightly higher risk. It is giving you 9%. Third friend has the highest risk, but it's offering you 12%. How much to give money to A, B, and C depends upon your risk appetite. If you're one of those who are very, very conservative, then ideally all your money should go to the friend A. But if you have a slightly higher risk taking ability, maybe 70% to A, 20% to B. But if you're one of those who can take high risk, maybe you can give maybe like a 30-40% to the person C. The problem is the person C, who are the funds who have got defaulted, were actually person C. They were giving high returns, but they were taking high risk also. Till the years those funds were giving high returns, people were very happy. People forget that when you're getting high returns is only because you're taking high risk. But the moment those funds defaulted, people started questioning that how can you default? But then you have to do your own, you have to be very cognizant of the fact that when you get high returns, it's only because you took high risk over there. It's like going to a bank. There are 2 banks, one is HDFC, which gives me 7% or 5% for an FD. And there's a cooperative bank, which is giving 7% or 8%, 3% extra. I can't just say, you know what, I want the 3% extra and I also want safety of my complete capital. It's not possible. So if you are one of those investors who are looking for conservative, safe funds, then there's a category, or look at the portfolio, look at AAA funds. What are AAA? It's the highest quality papers, which are the names over there, like HDFC Bank, ICICI Bank, PSU companies like RAC, NABARD, LIC Housing Finance. These are AAA oriented banks or papers. If you're conservative, go with these debt funds. But if you are one of those who want to take high risk, then put some portion of it, but that's your choice. Because those high returns will come with high risk. So you have to be very sure in terms of where you are investing.
Thanks, Amit. The next question is
I just finished one line. So in finance, there is nothing called as free lunch. Okay. If you get risk, if you get high return, that means there's high risk. There is nothing called as high return with low risk. It's not possible. In finance, it's not possible.